lot of people are unnecessarily confused by the financial system. It sounds like a big, complicated uh, behemoth. And some of it can be complicated, but the basics of the financial system are very, very simple. It's just a process of matching up two parts of the economy. The two parts are called savings and investment. Now, people hear the word investment and they think of stocks and bonds and mutual funds and uh, credit default swaps and all kinds of weird and unusual things. But really, what investment is simply spending money to expand your business, to grow the production process. And the reason we have a financial system at its core is so that people who want to grow their businesses can find a source of revenue, can find someone to lend them money. The whole process basically comes down to setting savings equal to investment. And that's really the whole process. Now, for that to happen, you need people who are willing to save and you need people who are willing to invest. And you need a market because you have two groups of people who are bargaining, if you will, over the same thing, funds. And in order to entice a saver to save, that saver has to have some sort of financial compensation. That's called the interest rate. When you save money, you get paid an interest rate. And when you borrow money for whatever purpose, you have to pay an interest rate. It is the price that you pay for using somebody else's money. So whether you're borrowing for school, whether you're borrowing for a car or a home, or to grow your business, you have to pay an interest rate. Now, when we put these two things together in a market, really all we're doing then is trying to find where the supply and the demand intersect in this market. Now, at the macro level, what we're looking at is the process of getting savings into the hands of investors. So what does that mean? Well, remember our GDP equation. The GDP equation says that GDP is equal to the consumption plus investment plus government spending plus net exports. Now, to simplify things, we're going to drop that net export component. And that leaves us with GDP, or national income, is equal to consumption plus investment plus government spending. Now, if we rearrange this equation a little bit and put income, or GDP, minus consumption minus government spending, which is funded by taxes, we get what you have left over at the end of the day. So we take your income, we subtract what you spend, we subtract your taxes, and whatever is left over is referred to as savings. So we've got on the one side of the equal sign an identity that's basically boils down to savings. And on the other side of the equal sign, we have all by itself investment. Savings equals investment. And that's what the financial system is designed to ensure. If we put this into a model, all we're doing is we're going to show a demand curve. The demand curve comes from the investors. Those are the people who want the resources to grow their business. The supply comes from the savers. Those are the people who have the money. So when you put money in your bank account, when you put it in a checking account or a savings account, when you buy bonds, you're really saving. And the investors are the people who take that money and grow businesses with it. Where the two lines intersect, we find the equilibrium quantity and the equilibrium price. But in this market, the price is called the interest rate. That leaves us with one thing. What is this market called? Well, this is the market for loanable funds. Loanable funds, those are the things that get lent to investors. The things that savers have that investors want. And when we match those two things up, our financial system works pretty well. Now, of course, those curves can shift. If, for example, government gives tax incentives to firms to invest, that's going to increase the demand for loanable funds. That's going to shift the demand curve to the right. And assuming savings doesn't change, that's going to raise the interest rate. And it's going to increase the amount of activity in the economy on the investment side. as the quantity of loanable funds shifts to the right. There are many other things that can shift the demand and supply curves in this market, but this is one example of how the interest rate for loanable funds can change.